Hey, free timers. If you've ever wondered what a portfolio built for time freedom actually looks like, this episode is for you. Today, we're unpacking the Time Freedom Portfolio, the only investing approach designed around your specific lifestyle. There are other ways to invest, but not if you're a free timer. We'll figure out how much cash to hold, how to get the best returns, and why your goal isn't purely building wealth, but instead maximizing freedom. Let's get on with the show. Welcome back to the Time Freedom Podcast, where you can learn how to rethink your work and your money to create a life you love right now. Join us for insights to help you find meaningful freedom so you can choose how and when and with whom you work for as long as you want. Here are your hosts, me, Brian Herriot, and Kirby Denison. Hello and welcome back. This is the Time Freedom Podcast, episode number 16. We're going to talk today about the Time Freedom Portfolio, which is the capstone episode for the previous two episodes we talked about. So 2 episodes ago, we talked about the investing side of the barbell, if you recall. And then last week, we talked about the cash and the kind of the safer side of the barbell. This week, we're going to talk about how do you mix those two together into what I've called the Time Freedom Portfolio to maximize how your money is working for you if you choose to live the free timer lifestyle. But before we get into that, let's just introduce each other. So first I'll introduce Kirby. She's my wonderful co-host and owner of Kirby and Co. and mother and daughter and sister too, right? Yep, sister.
Yeah.
And all things wonderful in Colorado.
Yes. And Brian is author of Time Freedom and who's brought us here all together. It's been such a fun journey just learning more about different concepts that kind of challenge the norm. And so that actually flows right into today's episode, which I know some and I know I'm going to even learn more and have probably a lot of questions. But first, before we jump in, Brian, catch us up. What's been going on?
Yeah. So it's easy to do these podcasts. And what I mean by that is I'm in the middle of copy editing the book right now. And that means that I'm looking through the entire book like weekly to continue to make improvements on it. And so all of the concepts are very fresh in my mind. So it's easy to talk about. But not many people know that when you write a book, I didn't know this either initially, but there's different types of editing. And so there's, of course, all the editing that you do before you put forward your best effort. Then there is what's called developmental/substantive editing. And this is where you kind of work with your publisher and the editor their focus is, does this book work, right? Is it structured in the same way? Is it not repetitive? Is it as clear as possible? Does it deliver on the promise that, you're offering your readers? That's a heavy lift. That's all been done and in the past. The next stage is the one that I'm in the middle of right now, and it's called copy edit. And that's not proofreading. Proofreading is the third one, or I guess the fourth one in my example. Yeah, but copy edit is where you work with a different person. And I've actually had the opportunity to work with 2. I'll do a call out to Zoe Bird and Carla Myers, both incredible copy editors. But what they do is they take when you write 2 short sentences and they make it flow better into a single sentence that's, cuts out all the extra words. Like you don't write if you had a copy editor for this podcast, you'd probably take all the likes out. But in writing, you take out that, which I was pretty good about because I tried to do my own that removal first. But the word that I've noticed that they've taken out a lot of is of. And I'm trying to think of an example. So it's like this thing of this, and you can take of out and it means the same thing. There's just a lot of pruning of these extra words to make it that much clearer, because the whole goal, you want the person to see your book, buy it, read it, complete it, achieve the promise, and then tell somebody about it, preferably 2 people. That's how you get a book that takes off. There's 2 rounds of copy edit. I've gone through both rounds with Zoe. I'm about to enter the second round with Carla. And after I finish that, the book will be very readable. And it will basically be done with the exception of looking for proofing errors. And that's the last step. Just crazy. I saw that I spelled Kelly Blue Book Kelly, but it's Kelley. I listed a book from Susie Orman that I called 7 Simple Steps to Something About Your Money. And it's actually 9 steps. Like just the level of editing and the detail that goes into it is incredible because,
Mhm.
you know, I just feel very confident that at the end of the day, this book is going to be as accurate as it possibly can be with no mistake. I mean, there's always, I'm sure, one or two that get through, but it'll be good. It'll be good. And it'll, there's no reason for a reader to go, well, he used that word wrong. So I don't, trust his
Mhm.
authority anymore.
Yeah, and I think the amount of well, I mean, you and I did a lot of editing before we even got to that
Yeah.
point, and when you were saying, removing likes, I already would not want to be an editor because the amount of likes that I use personally in our podcast is insane. The edited versions do not show the amount of likes. There's
Oh, so
probably 100.
you cut the likes out
I
that you
do.
say. Good.
I do because I actually in the first episodes, you probably if you go back and listen to it now after listening to this episode, I didn't, and then I realized how many times I said it, and it was driving me crazy. The recent episodes, yes, most of them were taken out.
When you listen back, you hear yourself, not you, but we each hear ourselves say the things that we always say. I almost don't even want to know what mine is because then it'll be in my head and then I won't be able to
I
speak normally.
yeah, I even catch myself just when I talk, when I say like, I'm like, "There it is again. What's happening?"
So today we're going to talk about a recommended portfolio, which again, I have to start with that I am a financial advisor, but for all of you who I don't know, because financial advising is such a personal service, this has to be treated as just educational or entertainment if you think it's funny. But the time freedom portfolio, 2 points I want to make. One is that it's not a hard and fast rule. Like I don't say put this percent in here and this percent there, because in our time freedom journeys, we all are at slightly different stages and moving through life doing different things. Some of us are entrepreneurs, some of us are not. And so I have instead kind of a range for some of the different types of investments. So think about that first. And then secondly, I've been asked, is this the way I should invest? Like, is this the way? And again, this is something that I learned from Morgan Housel's Psychology of Money book. There is no one right way to invest. There's only the right way to invest for the goal that you have. So, for example, let's say you were 90 years old and you had $10 million. Okay, you're good, right? You don't need to make, like, you could argue if you're not worried about passing money on to your kid. Oh, and you don't have any kids and,
Mhm.
for all these caveats in here in this situation, there's no reason that person just couldn't put all their money in a savings account and then just live off the very small percentage that it earns. If you're living the free timer lifestyle and you don't have 10 million, that's not the most optimal situation. Maybe there is an example that you could come up with. But my point is, here's another one that I thought about just the other day, which was people were like, well, what do you think about crypto? What do you think about these ways on which these new apps like Robinhood and whatnot, like you can do all these complex derivative trades and it's basically gambling, right? Like what do I think of that? Should anybody ever do that? And actually my answer would be maybe. If you're 20, you have, I don't know, $2,000 to your name and you have no responsibilities other than yourself and you can live on $50 a day and you want to strike it big, why not try that?
Mhm.
What if you could turn that $2,000 into $100,000? Why not try? Maybe you lose it all and then you could try again later. Like I'm just saying, like in different circumstances, doesn't like I
Mhm.
don't think there's a right or wrong way to invest. It's just how do you want to invest for the goal that you have? And what we're talking about here is that you want to live this life. You're my kind of very focused niche is kind of a middle career person who's decided, oh my gosh, I don't want to just stick with my employed job anymore. I have some savings that I can rely on, but not enough to live forever. I want to
Mhm.
keep working, but in a more flexible way. What's the right way to invest for me? And then, you can adapt that if you're earlier in the process or later in the process. And if you don't want anything to do with time freedom, hopefully, like, why are you listening to this podcast? But maybe there's a complete different way to invest. Does that
Yeah.
resonate? Does that make sense, Kirby?
Yeah. Yeah, it does. And, when you were talking about I think you called it Robinhood. Is that like the day
Robinhood.
trading?
They do day trade. Yeah, you can do
Okay.
all. It's just like almost like gamification of actual real trading.
Trading. Okay. I only know a few people, one person that actively does it, and there's been some stories of a lot of losses, also a
Sure.
lot of gains.
Yeah.
But my brother actually this weekend was at a whole conference around day trading, which I did not even know was a thing. And I was like, I don't know. For me, I'm not a gambler, so
I'm a not a risk taker.
Mhm.
And so, I don't go to the casino because it's a net losing situation. And I know that,
Yeah.
like, the house wins. Investing in the stock market is a net winning situation. So I will invest in it, but I'll do it appropriately. And for me, the most important thing is to make sure that my money and my work last in such a way that I can do this flexible lifestyle. And
Mhm.
so I want to align everything around that. And that's what the time freedom portfolio aligns.
Yeah, I think that's a good point, and I think that's a great transition to kind of move into I know you have 5 principles around the time freedom portfolio. Do you wanna share a little bit about that?
Yeah. And so just to set it up, what we're going to talk about is the time freedom portfolio is a combination of what we talked about last week, that safe money that you have in a money market. We'll call it just say a money market, the cash savings of some percent, and then some percent in a passive stock index fund, usually an exchange traded fund or an ETF. And so we'll get into the percentages in just a moment, but I want to explain first why I believe that passive index fund is the right way to invest for time freedom. There's other ways that you could take that money on the right end of the barbell and invest it more,
Mhm.
in a higher return, but I choose low cost passive stock ETFs. And it's because they fit well along these 5 principles that we'll go through. To explain the 5 principles, I want to take that index investing and compare it to another type of investing, which is a very valid way of investing. It's just that it doesn't quite work perfectly, I believe, for time freedom. And that is this concept. It's called value investing. And so let me just explain. Are you familiar with this at all, Kirby? Okay.
No, not with values.
Yeah, and so our listeners may not be as well because this isn't like a high-end investing podcast, and it's not designed to be. So value investing is kind of the early Warren Buffett style of investing, where you look at the stock market, you study you pick a
Mhm.
stock, you study the business, and you see, well, this business is really valuable. Then you look at the corresponding price of the stock, and you see that it's like trading low, right? It's like
Mhm.
it's undervalued, and so you're like, I'm going to buy that stock because then the market's going to recognize that it's worth more and then come back up. And then that's how you're going to make your gains. So you're basically value investing is looking at the business versus the stock price and trying to find ones that are undervalued and then buy
Mm.
them and wait for it to go up. So totally, I
Yeah.
mean, that's a very valid approach. It
Mhm.
requires different skills. So let's take those two. And then passive indexing is just like have a fund that tracks the whole US market, the S&P
Mhm.
500, and I just put some money in it and I let it follow the index all the way up or down.
Mhm.
It's like that's so we're going to compare those two. We'll say passive indexing, value investing. The first principle is low cost. All right. So we've talked about this before, but the lower you can keep the fees, that's like guaranteed return. So you can capture all of the return of how you're investing. What are the fees for passive indexing? Well, if you use a fund like Vanguard, they're very low. And what about value investing? Well, if you invest in like individual stocks and you do all the research, I guess from a cost standpoint, it's also quite low. You could say that from a time perspective, it's high cost because you have to do all that studying, but let's say it's low. So we've got low for both of those. So that's great. Number 2, diversified. How diversified is passive indexing? Very diversified because you've invested in, well, if you invest in one that tracks the S&P 500, 500 companies, you get a little bit of all 500, very diversified. Value investing, if you're doing it kind of on a stock by stock picking standpoint, it's not as diversified because, for you to do the work to find 500 undervalued stocks would take too long. You won't do it, right? You won't do it. And so then
Mhm.
you're not nearly going to be as diversified. Next one, easy to manage. This is where we kind of get into the time stuff, right? So is it easy to manage your index fund? Sure. You just buy it and sell it, whatever. Is it easy to find good valued stocks? No, because for one, you have to do all the work. Then the work has to prove that it's undervalued. And
Mhm.
then you have to get in and then you have to hope that the market somehow finds out that they were wrong and you were right.
Mhm.
there's just a lot of things. It can possibly be done. Certainly, Warren Buffett's done it amazingly, but he's Warren Buffett. We're
Right.
just ourselves, right? So, in that case, easy to manage, passive indexing, yes. Value, no. So we've got kind of 3-1 score so far for passive indexing. You can see why I'm leaning that way. The next one is no investment expertise required. A free timer. You value your time. You don't want to necessarily be tied to your laptop studying stock charts, right?
Mhm.
And some people just happen to love it. Great. That's fine. But like the vast majority of people have their lives to live and other things that they're passionate about. So I like to say I want an investment strategy that requires no investment expertise because I don't want to spend the time to have to learn it. How hard is it to buy and sell an index fund? Well, you have to figure out how to do it. But once you do, that's all you need to do. How do you figure out how to value companies and determine if they're how they value compared to how the stock value is valued? That's a lot more work and a lot more expert.
Mhm.
You have to perhaps know the industry that that company's in. To get diversified, then you need to know multiple industries. It's very, very
Yes.
difficult. So now we're up to 4-1, right? And then easy to test. This is one that is not often talked about, but it's the way that like I think you get around like hucksters and people that are trying to sell you things. Is like if the way that you invest your money, if you can do it in a way that you kind of test it out. So let's say you want to invest in passive indexing, I just want to do it with $100. You can
Mhm.
absolutely do that because you can buy something, a very tiny amount of an index for just $100, and you can watch it go and you can learn from it. That's a wonderful thing. You could actually do the same for value investing. Many places you can buy parts of shares of a company, or you could pick a company that's undervalued that has a cheap share price, so you could just buy one share for $400 or something like that. So in this case, this helps. This is to protect against the person who's like, I got an investment deal, but it's going to cost you
Mhm.
$1,000,000, or it's going to cost you $10,000, or you just need $5,000 to buy in
Mhm.
without being able to like test it out and try it out. That's risky to me, and I don't advocate for that. So I think our passive indexing versus value investing score ended up 5-2. So again, value in investing, totally valid strategy. Great for the people that want to spend time on it. It's just in time freedom, I advocate for passive indexing. And that's
Mhm.
why we'll use that combined with the money market / high yield savings, and we'll come up with the appropriate strategy
Yeah,
and mix.
and one of the things actually when you were talking about the value spending, so I think that that is a lot of what our Edward Jones person does. I mean, all that's all she does all day long is watch, and check the values and research. And when you were talking about that, I just remember thinking when she first was sharing to us about everything, I was like, no way.
Yeah.
I do not want to.
What's also interesting about a place like an Edward Jones or any of those, more traditional
Mhm.
financial advisors is that usually, and maybe this is different for your case, but like the people that interact with the customers are
Mhm.
more like managing the client relationship and
Mhm.
helping you feel comfortable and not freak out when the market goes down
Mhm.
and get you your quarterly reports and meet
Mhm.
with you. There's people in the back office
Mhm.
of what was it? Not Raymond James.
Edward Jones.
Edward Jones. What's with these dude names, like
No, what the heck?
I know. Um,
It's 'cause women don't wanna deal with it.
yeah, they're in the back, the investment
Mhm,
management group, they're the ones that are analyzing and determining which
mhm.
funds to invest in and which stocks to pick and all of that sort of stuff. So, but yeah, that
Yeah, that's a very good point, and I mean, we're fortunate and probably an anomaly in that sense because our person is higher up in
oh, there you
Edward
go.
Jones, and
Hmm.
but definitely her front staff is that way, and our old agent and everything was that way, but I'm curious, so after we know that passive indexing is
Yes.
obviously the way to go, how much do we put in?
Yes, good question. So there's two ways to think about this, and the first is percentages, and the
Mhm,
next one's going to be like how much in terms of
mhm,
like how many years could this last you? But I'll talk about that in a second. First, let's talk percentages. I recommend a range that is actually was initially initiated by a comment in an annual report for Berkshire Hathaway that Warren Buffett wrote in 2013, I think it was. He wrote a letter and said in his letter to anybody that invests in Berkshire Hathaway, he's like, when I die, I'm going to instruct the executor of my will and the
mhm,
person that's managing my money, when I give my money to my next of kin, that they don't have to learn the business of that I've started and trying to pick all the right stocks. He's like, I'm going to put all of it in. I'm going to put 10% in the equivalent of a cash savings account. I think he said treasury bills, but the same thing. And 90% in a low-cost passive index fund that tracks the United States stock market. So he is recommending in his letter 10% cash, 90% stock index. I think, now think of it this way, that's a lot of money he's talking about, right? So let's say it's $100 million that he's giving to his next of kin. 10% of $100 million is a lot of money.
Right.
It makes sense that it should be 10%. Not all of us have that much money. So I think 10% can be low. And so I recommend 10 to 30%. I call it a 20% cash swing from 10 to 30. So you will usually, kind of based on a variety of factors that I have a short little quiz that can help you get a quick assessment of, to determine, between 10 and 30, what should that be? And like, for example, if you know you are working and you want to start a business and you need some money set aside to start that business, you probably put that money in cash. And so your cash percentage will be higher than the next person who isn't about to do that. And maybe the stock market's also very low valued right now. So you want to have more tilted towards the stock side so that it'll kind of come back up. So in that case, you might have a lower, more closer to 10% in your cash. And also that 10 to 30, it also breaks down a little bit if you have very little money or a ton of money. I'm just talking for the normal kind of average person that has an average amount of money, 10 to 30% is about right. Now, let's say you have $1 million and you choose 20% cash. That means you have $200,000 in cash in your portfolio and $800,000 in stock index. Here's another way to think about that, to know if that feels right. Based on what you spend, how long would that $200,000 last you? So let's say you spend $100,000 a year. That's a 2-year runway. Okay. That for many people feels great. It feels freeing, because if you lost your job or you decided to proactively quit your job because you hate your boss, it happens. You can, because you have 2 years to live, and you can do a lot of things in 2 years. You can pick up side jobs. You can find your perfect job. You don't have to just take the next job that's available. So those are 2 wonderful things that you could do that you wouldn't otherwise be able to do. So what I advocate for the kind of duration of time is, if you look at your living expenses, once you calculate your percentage, try to have between 6 months and 2 years of living expenses in cash. Because again, you might have lower if you have a partner who works, or you have expenses you can cut way down because they're, they're very dynamic expenses. I mean, you might have to have more if it's just, you're the only breadwinner, or you have a ton of expenses you can't reduce. That's why you might want to hold more. So again, there's reasons why you might have more or less, and the reason why I give a range. So how much cash? 10 to 30%, so long as you're in kind of the average amount of money, and then between 6 months and 2 years of living expenses. One last thing. The amount that you settle on, you should feel like, oh, that's too much, and oh, that's too little, because you want it to feel wrong on both sides, because then you know it's right.
Then you're right in the middle.
And I feel the same way. Like, I look at it, I'm like, gosh, that just seems like so much cash. Like, I shouldn't have that much cash. It should be in the markets. But then on the other hand, I'm like, oh, wow, I could live on 2 years off of that cash. Like, how freeing do I feel? That's so freeing to me to feel that way.
Yeah, absolutely. And I guess that's a good point to remind our listeners of, it's all based on their goals, and that number is going to feel different for each of us. So my next question would be, what about bonds?
Yes. So you notice that bonds don't appear in the time freedom portfolio. And that is because bonds have features of both the cash and the stock. So they're kind of in the middle in that barbell. They're on like the handle. And that's why I really don't recommend them. So they do give off some money, like as a safety, but they can also go down in value. So they are a good investment type for various types of investing strategies. Especially if like you're traditionally retired and you just can't work anymore, you should have probably some bonds associated along with your stock index fund that's growing. But the way that I handle, the free timer has the ability to work part-time, and that's how they're covering what bonds would otherwise provide. So that's why I think of bonds as for people that just can't work anymore, that you would probably want to add that as well.
Yeah.
So again, people will differ. People will say that's bad advice or different advice. Again, like it's for this specific niche of people that I believe that's to be the best way.
And that makes total sense with the bonds versus, our part-time work. So I think that's full alignment.
All right. So in the book, I have a 5-question quiz, and it's of the same style of all the others where you basically score 1, 2, or 3. And so the idea is that it's so simple you could just keep track of the scores on your fingers. All right, so I'm going to read each one, and this is going to help us determine what percent of money we want to put, what percent of our portfolio we should hold in cash or cash equivalents or the kind of the safer conservative side. And then once we get that percentage, then we'll kind of do how does it feel in terms of how many years worth of living expense this would cover for me. So let's and again, we could do far deeper analysis on this, but this is kind of a high level, and it kind of gives you a sense for the types of things that you're looking for in terms of why you would hold more or less cash. So number 1, the question is, as of today, I expect a large personal expense or business investment in either 5 years, 3 years, or 1 year. If you were to answer that, when would you see kind of a big investment in your business or in your life?
I would say 3 years.
3 years. Okay. All right. So that's right in the
We're
middle.
building a house eventually.
Okay. Yeah, that's a value of 2. Sorry, we'll keep 2. Track 2 for me. As of today, reducing my living expenses or increasing my income at work is difficult or somewhere in between. So how much are you able to either cut your expenses or raise your income? Is it easy, medium, or difficult?
I would say easy.
Okay, cool. So that's worth 1. As of today, my comfort, skill, and interest in investing lies mostly. So how would you assess your skill in investing? Are you mostly interested in market investments, like because you're like the manager personality? Or are you more like my business and real estate? You're the maker personality. Or is it somewhere in between?
I would say somewhere in between.
Okay, so that's worth 2. As of today, I will use some of my savings and investment for some daily lifestyle expenses within 5 years, 3 years, or 1 year. So I will use some of my savings and investment. So in other words, I need to use my money that I already have saved, right?
Mm-hmm.
And I'm going to use it for at least some portion of my living expenses as soon as within 1 year or 3 years or 5 years or more.
I would say beyond 5 years.
Okay, so worth 1. And then the last one, as of today, the state of the stock market is currently extreme in that it is either suffered a recent very large loss, no way, or is at or near new highs. That's a yes.
Yeah.
So the first ones are personal. The last one is like the environment. So that's worth 3 actually. So what do you have
9.
total? 2 plus 1 plus 9. Is that what it was? Okay.
I use my fingers.
All right, you use your fingers. Awesome. So the goal is what you do then after you score your number is that you double it.
Okay.
So 9 times 2 is 18, and
So
that is the recommended cash allocation. So it falls between 10 and 30, 18%, 18 to 20%. So kind of right in the middle. And then I'm not going to ask you to tell you what you spend, but think about what you spend in a year and compare that to what 20% of the amount you have saved is, and how does that feel? Is it somewhere in between 6 months and 2 years?
Yeah. That's interesting.
Yeah. So again, it's a jumping off point.
Yeah, and I think that's a good, easy, like you said, high level space. And then if you're not sure about your living expenses, definitely go check out the No Budget episode.
That's right. Yep. And because that's where you refine your lifestyle expenses number within the Time Freedom formula, which is also in an even earlier episode. For the Time Freedom Insiders Club, go to timefreedom.life and scroll halfway down the page or wait 10 seconds until the pop-up says, become an insider, sign up, and you get access to chapter 1 and then also a secret podcast where we give you the kind of the ins and outs of what's going on in this journey. And as well as I'm also reading all of the chapters of the book early and prior to its release.
Yes. And don't forget to like and subscribe on all of our platforms for the podcast and also on YouTube.
Thank you so much. We'll see you next week where we're going to talk about a crazy new idea. It's called Fast Follow Investing. We'll see you then.